our lines back. But Sachin Shah is also meanwhile with us from MK Fund Manager, of course. Sachin, afternoon. Sachin, are you guys kind of getting tempted to? Oh, nice look, Sachin. Yeah, completely changed. For a moment, I thought, is that Sachin or somebody else coming in, sporting a nice mustaches? Okay.
Thank you.
So, Sachin, tell us. Right now, are you tempted to trim some profits in any part of your portfolio, or are you holding on to the gains?
Ajay, that's a great tricky question at this point in time. To be very honest and frank with you, when you think about absolute returns, as you know, the last 1 year, particularly FY24, overall portfolio returns have been upwards of 40%, which is a great return. Even if you look at the last 3 years, I think the compounded returns are upwards of 25-30% compounded. So markets have definitely delivered what we were looking forward to over the last 3-4 years, and that's where as investors, we would always be a little bit tempted of taking something off the table. That's one. Second, we are also seeing some bit of frenzy, euphoria in certain segments of the market, particularly in the small cap space and those kind of things. Yes, so that does that definitely gives a thought that maybe there should be some profit booking, maybe there should be some re-asset allocation and those kind of things. But also there's a reality that we are equity managers. The index is always fully invested. We are benchmarked against indexes. So we don't actually take those cash calls. It is the wealth managers who will have to decide because we are equity managers, and whatever money that they allocate to us as equity managers, we generally tend to remain invested.
Fair point. But you must be surely flipping positions, adding positions, or changing the complex, the entire framework wherever you're finding. Are you doing those kind of changes, trimming and adding on positions somewhere else, all of that?
Yes, so somewhere there has been, say for example, in our flagship product, which is MK Capital Builder, which is a classic flexi cap, multi cap kind of a PMS strategy. What we've done there is, say for example, a year back we were about say 60% large cap, 40% mid and small. If you take maybe 3 years back, we were probably 55% large cap and maybe 45% mid and small. As on today, we are now 70% large cap and about 30 odd percent mid and small. So that's the kind of the move that we've done in terms of the portfolio construct, where we've moved more towards the large caps at this point in time. Because in each of the sectors, at least where we are invested in most of the secular sectors, whether it's auto, bank, private sector banking, IT, pharma, some of the bottoms up businesses. In each of these sectors, the relative valuation comfort that we have is in large caps more compared to a mid and a small.
You have a good dose of private sector banks in your portfolio, I understand. Is the worst over for private sector banks, Sachin?
We believe so. So, for example, in the sense that if you see the last 1 year, there has been serious under ownership, I would believe, in that sector. That's one part. But I think even in terms of the earnings growth, I think they have done a decent job over the last 12 to 18 months. Of course, the valuation premium was significantly to maybe the public sector banks or some of the other smaller banks. I think that bridge is already taken care of now. And we believe that from here on, as again, the quality will start performing even better. And so we believe the private sector banks today, the top three large private sector banks have now, got a lot of baggage that they had because of whatever challenges that they have had in terms of their M&A or some of the other activities. I think all of that is behind them. And from here on, the numbers should actually, the growth should be very secular for the next 3 to 4 years.
Sachin, what are you doing to your positions in the auto OEM side? I see Eicher is one of your stocks, but what I want to ask is that the two-wheeler part of the auto OEM ran up quite a lot, or got re-rated going into Ola Electric because they themselves had a lot of two-wheeler EV play embedded in them. Now there's talk of good monsoon and higher rural push. So two-wheelers are likely to do even better from here on, or they've run up, so one should be trimming some positions.
Ajay, see, we have to also be cognizant of the fact that the penetration levels in the overall two-wheeler segment is fairly high. So from that perspective, I think the overall two-wheeler growth will be in maybe mid to high single digit kind of a growth over the next 3 to 5 years is what we believe. But the real big story today in India, not only for two-wheelers but for across products and categories, is the game of premiumization. The young aspirational India is very much looking to upgrade themselves to premium products. So even within the two wheelers, like you just mentioned, Eicher Motors is one of our holdings, or even if you look at Maruti, all of those companies, we are very clearly, playing the premiumization story over there. We believe that today, say out of a probably 15 million two wheelers sold, less than a million are probably in the premium category, the Eicher Motors positioning where they are, the 350cc and above. So we believe that segment will actually grow much faster than the overall two-wheeler category. So the premiumization story across the auto, even within the, like say, if you look at the four-wheelers, right? What SUV as a segment used to be less than 20% of the overall passenger vehicles. Today it's already more than 50%. So that's the kind of the premiumization we've already seen, and I think that will continue. Not only that, if you will see some of the models within Maruti, for every model they will have 4 or 5 variants. It starts with the base model and the top of the line. So maybe about 10 years back, probably the second lowest, which is a model notch above the base, used to be the highest selling variant. But today it is the second highest model, which is a notch below the top. So that's the premiumization game. The premiumization trend that we are seeing actually across categories. So we are more positioned for the premiumization story within the category, and again within the segments wherever investors or the consumers are looking for more features kind of products.
Are you watching out for Hyundai IPO as well? Because after almost 2 decades, you'll be having a passenger vehicle IPO.
Yeah, so we're looking forward to it. I think it's always a good thing to have because both Maruti and Hyundai put together will have nothing less than 75-80% plus market share even at this point in time. So it's always good as investors to have more options to invest. And Hyundai numbers on the face of it look very, very good. Their financials are very strong. They are a formidable player within the passenger vehicles, not only in India, but they have been also very strong on the export side for many, many years. And I think they are also they've already launched quite a few EV products. So I think even that part, they are far more progressive. Indian consumers have embraced, I would say, Hyundai as a product for the last 2 decades, at least that I can think of since the Shah Rukh Khan ad, and they have delivered to whatever the consumers have been looking for. So I think it's a great another investment vehicle for long-term investors like us.
Sachin, what are your thoughts on electronics? I see some mid-cap electronic plays in your portfolio. Are this entire electronic PLI and all, we thought that up till now Dixon and Ambers of the world were actually the big beneficiaries. But have really meaningful large orders or good visibility started coming to names in the mid-tier size as well?
Yeah, Ajay, so this electronic manufacturing space, I think that's a mega trend, right? It is now fairly well established, and we believe that this is here for at least 5 to 7 years with all the final the government support that they got. Because if you go back 10 years, there was a lot of inverted duty structures which the government got corrected. In the last few years, we have also seen a lot of PLI support over there. There's a lot of catalysts have come into play. Plus, the overall demand of alternate supply chain from the global customers is another very big mega trend. So today, this China plus one, Europe plus one is a reality today in the electronics manufacturing space. If you talk to most of the companies, you get a clear sense that what was inquiries for last so many years has actually now got converted into hardcore order books. And you will see these order books getting executed over the next 3 to 5 years, is what we can understand by meeting a lot of these companies. So we believe electronic manufacturing space is a trend here to stay for at least next 3, 5, 7 years.
What's happening in the mid-tier engineering companies? They had the time of their life. Many of them have quadrupled, if not doubled. Are things looking fine there in terms of valuation versus earning visibility?
Again, a tricky question. Earnings growth very strong. They have delivered very good. Outlook also very good. but I think valuations are definitely a bit ahead of time. If I would say not in the euphoria zone, but they are definitely running a bit ahead of time. Uh, so it's going to be very bottoms up, very company specific when it comes to looking at valuations, understanding the kind of the near to medium term order book that they have and that they can execute. Also, some of these engineering companies have done very well in the domestic market in the recent years because again a classic cyclical bottom that they hit, and from there in the last 2 years they have delivered. But the real big story is when some of these companies will actually be able to go and crack the export markets. And at least a few companies that we track or we've also invested have been trying to go and crack into those European markets or in some of the US markets, also North American markets. So I think the real big, the proof of the pudding for this current valuations to sustain and to deliver returns from even the current prices is going to be whether some of these companies are able to actually go and crack into the export markets. Now, if that actually plays out, then yes, we still have a long road. But it's a probability game at this point in time. It's not, the valuations are not so cheap where the margin of safety is very high.
All right, Sachin, we'll let you go on that one. Thanks so much for your time. Before we wrap out, also hear out my colleague